Hey there, everybody. Thomas Wood with Basecamp Trading. It is Friday, October 10th or 20th, excuse me. Living in the past. And we are going to take a look once more at this series on how to recover from large losses. So this is going to be part 2 of the series. And in part 1, we talked about how this is one of my equity curves from an account I'm trading, or one of the accounts I'm trading right now. I had a pretty big drawdown here at one point, and since then have recovered, and the account's up over 50% now. But the thing that happens with so many traders, and I see happening with traders all the time, is they come in, they have a big loss like this, and instead of slowly pulling out of it, they end up trying to add position sizing or recover too fast, and they end up just blowing their account up. Now, the thing you got to keep in mind, when you have a drawdown, drawdowns happen, losing trades happen. And like I said yesterday, just because you have a losing trade does not mean you're a losing trader. All right. The other thing to keep in mind, when you're trading, game over occurs when you run out of money, right? So what do we not want to do? Run out of money. So we don't want to take a small problem and turn it into a really big problem and get to the point where it's game over. As long as you still have money in your account, you can still place trades. There's still hope. There's still opportunity to recover and to start improving. So I want you to keep that in mind. All right. When you look back, and I said this yesterday as well, if I always tell traders that they overestimate, most people overestimate what they can do in a year, but underestimate what they can do in 5 to 10 years. So if you go back and you look 5, 6, 7 years from now and look at your equity curve, the retracement is going to be just a drop in the bucket, because as your account gets larger, position sizing gets larger and leverage gets larger, and it kind of snowballs. Gains start increasing. And even though you might have had a $5,000 or $10,000 loss before, when you're trading a $200,000, $300,000, $1 million account, that doesn't really matter. $10,000 loss is nothing by the time you get up to the size eventually. All right, so keep that in mind. In the grand scheme of things, it's just a small drop in the bucket. Now, what I want to talk about today is how do we discover what the problem is that caused the drawdown, and how do we get back to the point where you're showing and growing with these consistent returns, these consistently upward moving trades. So what we first look at is we look at your trade log. And I always tell people, and I've done an entire video on this, about how one of the biggest mistakes traders make is they do not have a trade plan, they do not have a trade log. And as much as I talk about that and tell people that's a problem and tell people to not make that mistake, probably 60% of the people I talk to, the traders I work with, even though they're working with me, they still don't have a trade log, and it's just unacceptable. All right. You need to be tracking every trade you're placing and why you're placing it. And the reason this is important is when you go into a drawdown period like this, what you want to do is you're going to take your trade log, you're going to take, let's say, your equity curve here, and we're going to cut your equity curve in half, just like this. And we're going to say, okay, what were the trades over here? And then you're going to look at, during this drawdown period, okay, what happened here? Okay, so what we're doing is it's like when you're a kid and you had those games where you look at two pictures and say, all right, what's the difference between the two pictures? You're doing the same thing with your trade log, and you're going to go back and say, all right, what was I doing here when I was making money, and what did I do differently over here that caused me to lose this money? And normally you'll be able to find something in there, a discrepancy, where you were trading and managing your position differently than you were previously. Okay, so remember that when you go through and you're in this loss and you're going, all right, let's take the foot off the gas for a minute. We're going to pause. We're going to stop trading. I see I'm in a drawdown. I see this is happening. Let's work on fixing it. All right, and you're going to pause, hit the pause button, go back and start looking at those two trade logs and going, all right, what mistake did I make? What was the difference here? And then once you identify what that difference is, then you go and you move forward. Now, some people tell me it doesn't matter what your winning trades look like, only look at your losing trades. Well, I disagree, because if you're looking at your winning trades as well as your losing trades, you'll then be able to say, this is ideally what it's going to look like. This is how the market should perform. And this is what it looks like when it's wrong. And the reason that's good is because then you can start getting expectations on how your winning trade should perform. So once you get into a trade and you have these expectations of, all right, I know that the winning trades, the winning positions I have, they start They look like this. I get in, and then within 10 minutes, I'm in the money type of thing. Or within 20 minutes, I'm in the money. Or within a day, I'm in the money. The most I'm ever down on the winning trades is about $200 or $300. Well, if you know that the most you're ever down on the winning trades is about $200 or $300 per contract, then you know, all right, if I'm down $400 per contract, the probability is no longer with me that's going to be a winning trade. So you go ahead and close out that position. All right. And what you're trying to do is optimize your equity curve and optimize your trading plan so that you're trading more and more of what works and less of what doesn't work. And as you go, you'll start marking down the mistakes you're making. Okay, made this mistake here, made this mistake here, made this mistake here. And you'll start avoiding those mistakes. And as you start avoiding those mistakes, your profitability will increase, your equity curve will smooth out, your drawdowns will start getting smaller. Alrighty? So that is it for part 2. Again, the big thing is for part 2, go back and look at your trade log. If you don't have a trade log, you need to start keeping one right now. Whether you're trading simulated or live, keep a trade log of what trades you're placing, why you're placing them, and look at, all right, what did the trades that were making money look like? What did the trades that lost money look like? What are the differences, and how can I avoid them? Alrighty, we will continue the series next week with part 3 on how to recover from losses, because there's still more to talk about. And that's it for today, though. Don't forget to like and subscribe if you want to keep on getting these updates. And until next time, happy trading, everybody.